Okay, welcome back. Markets down 127 points and 24,986 is where we are now trading at. Rupen Rajguru is with us, Head of Equity Investments and Strategy at Julius Baer. Rupen, good to have you here. You know, we were just earlier talking about standalone refiners, but I think you do have a kind of positive value-led call on OMCs. Correct me if I'm wrong. Oil marketing companies. Any thoughts on this pack, Rupen?
Yeah, hi. Good afternoon, Prashant. So, see, OMCs typically are trading bet. So, probably 2-3 months back, we had a positive call on that. That was basis the lower oil price, wherein the oil price was hovering around 60, 65. So, in the current moment, while the oil price will be volatile, but if oil price were to revert down, which is what we believe it would eventually be. At that moment, definitely we would be constructive on that, because what we have seen, as I think you also rightly mentioned earlier, that the GRMs have firmed up. I think the key for all the OMCs are the marketing margins. The margins are were before the oil price hike was close to 10, 11 bucks as compared to steady state marketing margin of $3 to $4. So there's definitely enough cushion. But while I think volatile oil price will keep these stocks under check, but yes, I would say watch out for if oil price were to come down, it will definitely have a positive impact on all the OMCs.
Mm-hmm. Hi, Rupen. Good afternoon. Good to see you, Ben. Well, the other pocket that you have liked, which actually hasn't performed too well, is insurance. But do you believe it's in for better times now, and valuations are as well are palatable?
Yes, hi, afternoon, Nigel. You are right. If you see insurance as a sector, while it has done well this year, but if you zoom out and see from last 3 to 4 year perspective, this sector has seen significant derating. And one of the primary reason for derating, apart from a little bit slowing earnings growth, was extremely tight or a regulatory environment which had more and more news which were negative towards that sector, starting from the taxation front and some of the other areas which we have seen play out. And hence we have seen a significant derating of the sector. Today, if you see what we believe, incrementally the regulatory environment is easing. If you see across the board, starting from RBI or SEBI, while as we speak, we currently don't have we are awaiting for a new IRDA chief, and our strong sense is that overall the environment on the regulatory side would be a little bit loosening, which augurs well. And we have already seen some of those tightening measures like banca assurance channels and all. Now they have reversed on that. So A, the regulatory environment is now better. B, from a growth perspective, we believe growth is coming back. Protection as a business is doing well. And in an environment where the interest rates are low, and finally we are seeing banks also cutting their deposit rates. So some of those non-par products which had lost flavor because a lot of banks were garnering, focusing on deposits. Now the focus will come back on insurance products, which typically are non-par products, and that again growth will come there. So combination of all that plus lower valuation, we believe this sector can see both earnings growth and re-rating. And hence, yes, you're right, we are constructive on the insurance companies.
Okay, insurance is an area that you like. Rupen, hi, good afternoon. Just before you joined us, our colleague was appraising us once again of the defense names and the way the valuations are moving. And we were just discussing this, right? Because valuation-wise, most stocks are trading above historical, average PE multiples. But what is your sense? I mean, overall, the environment that we are in, if someone wants to take fresh exposure, first of all, is it advisable or is it already too late?
Yeah, hi, Surabhi. I think I agree with this conundrum. And in fact, if you see today, intuitively, markets are second-guessing a lot of things. So probably they are second-guessing all the bad news are temporary, because I think, as you rightly said, the oil is not moving up. Ideally, we all would have thought that oil will flare up today, but oil just marginally opened higher and now it is lower. Gold, which is supposed to also go up in an uncertain environment, is kind of steady and not moving up. But at the same time, defense stocks, because it's good news for them, they are moving up. So ideally, defense stocks also should not move up, right? Because on one hand, we are expecting that this war is not going to be lasting for long, and the sentimental impact on crude and gold is not seen, but the sentimental impact on defense is being seen. So yes, currently markets is only focusing that potential good news from a sector perspective, and on valuations, clearly all these stocks are trading way above our comfort level. So while we agree with the long-term potential which this sector would have, but we would definitely want to see translation of order books into revenues and into cash flows. And currently, the stock prices are discounting all that in a seamless execution for next 4 to 5 years. So ideally, we would want a meaningful correction in those stocks to come through for us to be constructive on that, and those segments.
Guys, some of these orders, I'm not sure, right? Smaller companies, I saw one order, 13 crores, 14 crore order. Stock is up 10%. I mean, maybe the market is saying, well, orders are coming at least, and this is from DRDO, etc. But some of these are, I mean, there is a strong element of the theme playing out rather than, maybe at the margin. Maybe that is the dominant driver, and stocks are just sort of, part of that theme which is working out. I'm not talking about the larger ones like BEL, etc., but some of the smaller ones which are now sort of, in a way, getting attached to the broader defense tailwind, which is lifting all boats. I mean, I think there's a fair bit of element. So, you need to be careful if you're looking to play a theme. I mean, you got to be in the right space. Stocks across the board, even if there is a whiff of defense, have done exceedingly well, very, very well. So keep that in mind, because otherwise you run the risk of getting stuck. Mood changes, things start to drop, and the exits become difficult, especially in some of the smaller names out there. I think we've got 130 odd points. Market, of course, just not doing very much at all on the downside. Off the lows, though, I think that's the best way to kind of put it. NBFC is another area you still like, Rupen, from the financial space?
Sure. So, Prashant, in the current environment, one thing is very clear: the RBI, so to say, the bazooka which RBI has given the market by way of not only rate cuts but significant liquidity infusion. And now what we are seeing, the rate transmission is much faster. So typically in an environment like this, the wholesale funded financiers, so which essentially would be NBFCs and some of the other players, tend to get benefited the most, because while their asset pricing will take some time to get repriced lower, but their liabilities gets repriced immediately, because the bank loans which they are taken will get lower immediately. So there is a case for a NIM expansion. And historically, what we have seen in an environment of easy liquidity, lower inflation, and lower interest rates, typically NBFCs tend to do well, and the growth definitely would be much higher than the system growth rate. So from that perspective, we believe NBFC is in a sweet spot, and from our next 3 to 4 quarters perspective, we believe the numbers will be much better than the market expectation, and hence we are constructive on that side.
Okay, all right. A final question before we let you go, Rupen. I think you'd like some of these cement names as well. Some of them have come off a little bit because demand was a little softish in the first parts of the first quarter. However, the positive was that pricing has started improving. Are you still bullish on this theme? What do you like, large, mid caps, or any kind of geographic breakup you're looking at?
Nigel, you are right. Cement as a sector had one of the toughest years last year, and in fact, middle of last year, without any specific reason on either the pricing side, but they had seen the worst ever EBITDA margin, and thereafter, for last 2 quarters, we are seeing improvement. What we believe, 2-3 things. That this year, the overall industry growth rate, the volume growth rate would be much better than last year, which was sub 4-5%. This year, we believe it will be much higher. It will be closer to 7 to 8%. And as you rightly said, the key thing now is the pricing discipline is slowly coming back. Earlier, there was when the two groups were in loggerheads and there was a huge acquisition spree. There was a significant derating which we had seen for, barring the top two group stocks, or rather the top companies, the other companies had seen a significant derating. But now with the pricing environment coming back, some of those other top three, top four players, where we believe can see better days than what they have seen. And yes, from a pricing perspective, South has seen the maximum pricing impact positively, and the numbers of South-based cement companies will be much better in next 2 to 3 quarters. But from our pecking order, probably we would look into buying into the number 3, number 4 players in the cement market.
Okay. All right. Got that. Rupen, good talking to you today. Thank you very much for taking out the time and giving us the market perspective. By the way,